Schwab Asset Management is proud to sponsor the Advisor Upside podcast with ETF.com. With bond market conditions looking upbeat for 2024, Schwab stands ready with a suite of low-cost fixed income ETFs. Learn more at schwabassetmanagement.com/welcome-ETFs. Hello and welcome to Advisor Upside, powered by ETF.com. I'm your host, Jeff Benjamin, and in this episode, we're talking with Matt Bartolini, Managing Director, Head of Spider Americas Research at State Street Global Advisors. We're going to discuss some research by State Street on ETF trends. Hey, Matt, thank you for being here.
Yeah, thanks for having me. I'm excited about it.
All right. You did some research. You had a report. You looked at the ETF space in May, and your report came out shortly after that. A lot of big flows in May. There's a projection there that we could see the second biggest year ever in terms of ETF inflows. I know it's a forecast based on the first 5 months, but forecast is 890 billion, which would come close to the full year of 2021 of 909 billion. Matt, I want to ask you to kind of hit some of the highlights, and we're going to dig down into this research a little bit, but I want you to hit some of the highlights and then kind of fold in what you've seen since then as we kind of include the month of June.
Yeah, so I think some of the big highlights so far this year have just been some secular drivers of overall ETF inflows beyond what we're seeing from a market perspective. So there are sort of three central drivers on a secular basis. The first being low cost. Low cost ETFs continue to take in a sizable amount of inflows. They've taken in roughly, give or take percentages, but they've taken in roughly about 60% of all flows this year. And those
Wow.
low cost flows are really in those asset allocation building block instruments. So you think about your broad-based U.S. equity, international equity, fixed income, and all of those good things that really are being heavily utilized within model portfolios and just overall asset allocation vehicles. And that's a secular use case of ETFs because you have the transparency, the fee efficiency, and all that good stuff to go along with it to actually construct these multi-asset class portfolios. And so far in June, low cost ETFs have taken in 50 billion, which is 80% of all the flow so far in June. Clearly, there's a couple more days left in the month, but that just sort of showcases their
Mhm.
on the year now. It's 230 billion, so really a sizable amount of flows.
Okay, I want to let our audience know we're recording this on June 24th, so there is some days left in the month here. But Matt, can you define low cost? What qualifies as low cost? Because ETFs are kind of known for low cost.
Yeah, so we have a proprietary classification scheme that we utilize here at State Street Global Advisors. My team has developed it, and it looks at the obviously the expense ratio, but the exposure. So we don't just say, hey, anything under 10 basis points is low cost. We're actually
Mhm.
categorizing based on if it's emerging markets or high yield, and what is else also in that category from a fee perspective. But we're looking at it in terms of where there are suites. There are suites from other issuers.
Mhm.
Is it a low cost exposure that is a core, right? So we're looking at low cost core exposure. So if you have a 1 basis point super thematic ETF that targets 30 stocks, we wouldn't include that low cost. So
Mhm.
put these as your asset allocation building blocks that have the lowest cost possible among its peers. And it's not just the absolute lowest cost, but it's within that sort of bottom decile from a peer group perspective.
All right, interesting. So you can be low cost even if you're above the lowest cost of, in some of the broad market indexes that are cheap, right?
Yeah, that's correct. And I think when we just going back to the original question too of like what are the drivers, I only mentioned one, which was low cost, but obviously
Hmm.
it's driving a lot of the flows. The other one is sort of antithetical to this because it's active, right? And active tends to be a little more high cost.
Uh-huh.
So active ETFs have taken in 123 billion so far year to date, which is roughly 32% of all flows. But when we look at only the asset base, active ETFs only make up 7.5% of all assets, so significantly punching above its weight in terms of flow capture. And 123 billion is actually very close to the full year record, and we're only 6 months in. So
Mhm.
you look at a projection base, and that's going to be well over $200 billion and a significant record. And you're going to have assets well over 700 billion, maybe even 800 billion in just the active ETF marketplace. So those are two mutually exclusive secular drivers fueling
Mhm.
assets. The third one, which sort of spans both of these, is just fixed income. Fixed income ETFs driven by multiple use cases and portfolios, whether it's liquidity management, lowering fees, the ability to be active with index solutions, be able to make those relative value decisions your own, whether it's long duration, short duration, whether to use active managers, which there's a number of them now that have identifiable track records that span 3 and 5 year track records through pretty significant periods of market volatility. Fixed income ETFs just continue to take in assets. And that's, I think, also just juxtaposed against the return environment.
Mhm.
Core aggregate bonds have been a pretty bad place to be for a little bit over the past few years. And where we are now, fixed income ETFs have taken in 113 billion, and that's a simple proration of that will be 200 billion, and that'll be the fourth time in the last 5 years that fixed income ETFs have taken in 200 billion. So
Wow.
again, there's constant flows into those spaces that are underpinning overall ETF assets in the U.S. and around the world. And right now, as we talk today, U.S. listed ETF assets are over 9 trillion, 9.1 trillion, and there's no reason why that couldn't go up from here.
Mhm. I want to go down and dig down into a couple of those points. One is what is driving the flows into active? Is this kind of a late stage, late cycle move that you see when people are feeling like they need to get a little bit more strategic and can't just ride these indexes? Or is it looking inside the indexes and seeing some of the actually the securities that are driving the overall market performance? What are your thoughts on the flows into active?
Yeah, so I mean, first of all, it's both equity and fixed income flows. So active equity and active fixed income are on pace to break records. Actually,
Hmm.
the active fixed income ETFs have already broken records. With 39 billion, it surpasses the 32 billion
Hmm.
that active fixed income took already from a record perspective. And there, the driver is just the market environment is really conducive for active in this space where you have elevated levels of rate volatility. So if you look at the standard deviation returns on the ag itself, it's in the 90th percentile on a rolling 90-day basis. And on a 3 year basis, it's at its highest level it's ever been. So utilizing active to manage both rate and credit risks and tailor duration in one package solution is really attractive in this current market environment. And we've seen
Hmm.
a significant amount of active, intermediate core plus active bond ETFs have had strong performance this year overall. So the performance tailwinds are clearly at their back, and I think that's driving a lot of the overall flows into the active fixed income space. Because again, there's more track records and
Hmm.
things along those lines. On the equity space, it's a little bit different because it's not so much on the active equity solutions. It's not so much on alpha generation. It's about outcome oriented solutions, your derivative income, your buffered ETFs. Those are labeled under equities and they're active, particularly the buffered ones. They're active, but really, and I mean this in the nicest way possible, they're only active in name only. And the active component really is the flexibility around the options role, which you would
Hmm.
want in a strategy like that. And that's where the active component is. So it's not so much active security selection or what have you. It's not those alpha generation, although those funds are gaining interest, but the different types of active solutions that have come to the market that are more novel and have different use cases, that is what's underpinning a lot of the flows as well.
So is that a little bit of a deception in terms of asset flows into active when you've got different types of strategies that aren't what you would think of as a traditional active strategy?
No, I wouldn't say it's deception at all. I think it just requires a double click on the data and
Hmm.
an acknowledgement that active in a broad term is used for either seeking above market returns or seeking a
Hmm.
specific outcome. And one can be rules based active, systematic quantitative active, and one can be fundamentally active. And I think so. It's not really deception; it's just appreciating the differentiated use cases for active in this type of marketplace where You could try to beat a benchmark, or you could try to generate a specific outcome.
What about track records? I mean, the ETF space is just is like this lush garden with something popping up almost every day. How much do track records matter? It used to be back when you go back to the origins of mutual funds only, it was financial advisors. They wouldn't even look at something without a 3-year track record and without a certain amount of assets. Is that still the case? Do you think that track records are that important to financial advisors?
I think they're immensely important. And I think we see that bear out in some of the flow trends on a historical basis, where if you look at active ETFs that have been brought to the market, they typically follow a curvature pattern where assets build from the first year to the second year to the third year. If you look at the median ETF assets and new funds launched since
Mhm.
2018, you see that glide path that the median figure starts to grow right as you get to the third year, where a lot of due diligence teams will want to see, a 3-year number. That's the limited amount of time possible for a full market cycle in quotation.
Mhm.
So I think track records supremely matter. I think, back tests are not really that paid too much attention to. I think it's helpful, right? It gives you context. It gives
Right.
you some analytical support, but you're not going to make a multi-million dollar decision based on a back test, at least in my opinion. And I think we do see that come to fruition with new ETFs that do take a little bit of time to come to the market. Now, having said that, a lot of the new ETFs that have been brought to the market are either clone funds from existing asset managers in the mutual fund space, conversions, or are these sort of outcome oriented ones where it's not so much a track record you're looking for, but a philosophy and a process that you understand what you're trying to get at. You don't need that track record to see how a buffered, 10 plus down, 10 plus up type of strategy would work. But I think all else equal, track records really matter when you're evaluating something that deviates from the traditional market cap weighted paradigm.
Okay. In your report, you mentioned this reference a second half bump. You say, I'm quoting here from your research, 31% bump in the second half inflows. Can you walk us through that? This is something normally the inflows are higher in the second half than the first half.
That's correct. A lot of it has to do with seasonality towards the end of the year.
Uh-huh.
Predominantly, I'd say there's a handful of things. One is just tax loss
Hmm.
harvesting. So, we see this within our suite and the very highly liquid exposures that we have, whether it's in our sectors or S&P 500 franchise, where, you're going to see trades go off where someone might be, harvesting losses in single stocks or in a basket of single stocks and want to beta replicate to the end of the year. And that's where they'll own one of our S&P 500 ETFs from that perspective. The other one is, and this is really unique to our funds, is the derivative use cases.
Hmm.
Whether it's different tax treatments on futures contracts, holding them over year end, you can get taxed differently. While holding a physical ETF, you don't. So that will drive flows. There's also just year end sort of window dressing that takes place from that perspective. And then there's also, and again, this is really related to our lineup because you're looking at it relative to futures, the funding environment for futures, and this is very, very technical, and I don't think it is as widely appreciated in the ETF community as it should be. But in the futures market, your funding level, your implied financing in futures can become rich. And
Hmm.
in that case, you can go long S&P 500 ETF like ours and short the futures and earn that arbitrage. And it's called cash and carry arbitrage. And that does happen quite frequently. So for some of those reasons, they're structural and some of them are seasonal. And we do see those second half bumps take place pretty much year in and year out, with the exception of maybe 1 or 2 years in my mind that I can recall.
Okay. If you want to hear more analysis and expert opinion about what's going on in the markets and the world of ETFs, make sure to also subscribe to and follow Exchange Traded Fridays, brought to you by ETF.com. Let's talk about sectors. It looks like a little bit of an interesting counter trend in sectors, sector flows. Can you break that down for us?
So sector flows are sort of oscillating around a couple different themes, and they sort of tend to change based on market direction. I think where we ended the month in May, there's a little bit of a defensive bias, a little bit of a fade away from technology, which had really received a significant amount of inflows. We saw at the end of May utilities do well, and that was partly because of where the rate environment was, and but that really hasn't lasted into June. Utilities still have some inflows, but we've now seen industrials have outflows. We have healthcare have outflows. We have consumer staples and sort of modest inflows, but then tech has over 2 billion so far.
Yeah.
I think there's still a lot of dispersion within those sector flows as investors are trying to parse through the latest economic and fundamental data of what's driving the markets and see if the Fed can actually stick that soft landing where you would maybe want to have more cyclical exposures start to be allocated to. So still somewhat of a harder trend to dissect at the moment. Still seems that everyone is very focused on buying tech and buying growth because if we were to look at growth ETFs, which I think are tangential to the idea of owning tech, growth ETFs have taken in $16 billion in June, which is a record amount of flows. So, the sectors still paint a little bit of a risk on because you do have net inflows across the range, but there's still some gyrations going on below the surface.
Okay. Thematics, also a little bit of a negative story there, right? For flows?
Very much so. And it's been consistent for quite some time. And I think part of that has to go back to the rate environment, what some of these thematic ETFs hold. So just so for your listeners, 438 million of outflows in June,
Uh-huh.
4.4 billion year to date, 7.3 billion over the last 12 months. And this is our proprietary classification system. So I'm sure someone might have some different numbers. These are just our
Uh-huh.
numbers. I like our numbers. I think they have some robustness to it. Uh, but a lot of the thematic ETF exposures, they're going to hold small mid-cap securities that tend to be unprofitable
Mm-hmm.
in, in a, positive real interest rate environment where, the 10-year yield is now at 4.3% as we're talking today. If you're an unprofitable company, that's going to impact that high rate environment is going to really impact your forward-looking growth expectations. So a lot of these, firms and the exposures have trailed the broader market. And so while a lot of them have a tech angle to them, given the concentrated nature of tech returns into the, tech conglomerates and the lack of profitability where you would want some cash flow in a high interest rate environment, that has really dinged the returns and the interest for thematics. Now, we break it down by, by 13 different subcategories. The two subcategories that I would say have had consistent inflows are robotics and AI. Naturally, that makes sense. They've had 1.1 billion of inflows this year.
Mm-hmm.
The other one with any actual inflows of note would be future security, 655 million. And I think that, probably relates back to what we're seeing on a global scale from a geopolitical conflict perspective, but also what we do know of both parties probably would like to agree on defense spending. I think that's one area where we've seen some agreement on both sides of the aisle, which I think is pretty limited uh, of number of points you can draw to for that.
I want to shift gears a little bit here to ETF share class filings. By my count, there are 16 companies have filed for an ETF share class. This is something that Vanguard has, I guess, gotten one through the SEC, but that was for an index, a passive index-based mutual fund. Got permission for an ETF share class. They had a patent on it. That patent expired in May of this year. And there have been a bunch of filings since then, obviously, like I said, 16 or 17, but they're all active. They're all active
Yeah.
mutual funds. So, I mean, what's the end game here? Is this likely to happen? And even if it does, I mean, I can see where the mutual fund companies would benefit, but I think this also might introduce some tax issues for anybody owning an ETF share class, right?
I actually don't know the end game on this one. I think there's a lot of red tape to cut through before these, if and when or how they might get approved, and how that might change even under the approvals. Like, what does the
Hmm.
actual end state of the approval look like? Because ultimately, those mutual funds, it's a share class tacked on, they wouldn't be providing transparency. And for efficient markets to be made, and I get it, there's non-transparent mutual funds, but there's a lot of, sorry, non-transparent ETFs,
Hmm.
a lot of other operational structures included in that to allow for efficient markets to be priced on an exchange, whether it's a proxy basket or a reference asset or what have you. Uh,
Hmm.
for this, I don't know what you would use. Maybe use something similar, but ultimately, I think there's more. I have more questions than answers when it comes to the share class, and
Right.
I think most advisors would have the same thing. What benefit would I be able to get, out of just owning the mutual fund right now? What does the
Hmm.
tax efficiency look like? And how am I going to be able to have an efficient market priced on it if the holdings aren't known? And then it becomes a whole other legal issue of like, well, do you have selective disclosure? Because you're disclosing the holdings to one set of clients, but not all of them. Like, who gets all that information? So
Hmm.
far more questions than answers at this point. And I think that's why, any movement in the near term is highly unlikely.
Yeah. Plus, the SEC's got a lot on its plate right now
Yeah, I mean
already.
that goes also without saying. I mean, there's so many different other rules. I forget how many they have in session right now, but it is a sizable number. Obviously, the liquidity rule being one of those, which has been kicked around, I think, for a couple different years now.
And as I understand it, there's no deadline on these ETF share classes that by which the SEC has to respond one way or another, right? They could just sit there.
Yeah, I don't think there's a deadline or a clock ticking on them.
Okay.
At their
All right.
at their leisure, as it
Yeah.
were.
Wrapping up here, I'd like to. We got 6 months left in the year. I want you to just kind of look out on the broad horizon, Matt, and see and lay out anything that you see for the second half in the ETF space. I mean, you've already projected um, a near record in inflows. I don't know if you want to tweak that at all or anything else that you see. Will these trends continue? Will active continue to just take in assets as fixed income? I frankly, I don't really understand why money's going into fixed income right now, but it seems like maybe advisors are adjusting duration on the fixed income side in anticipation of rate cuts. I don't really understand that, but what are your thoughts on what things might look like in the second half or for the second half?
Yeah, I mean, I think part of it on the fixed income section is that it's outside of any market direction, right?
Hmm.
So we had like one of the worst returns in fixed income in the most recent years, and there was still 200 billion of capital plowed into fixed income ETFs.
Yeah.
And part of it is just the ongoing usage of ETFs in advisor portfolios to construct differentiated exposures, different profiles for their end clients, meeting different
Hmm.
parent needs. I mean, we are a generation, we're not my generation. I'm not getting, well, I guess I am getting older, but as a society, we're getting older.
Hmm.
It's going to be more need for stability and income, and one of the easiest ways to get that is through fixed income ETFs, with that sort of idea of democratized customization, right? You can really customize your portfolio in a very democratized manner across all different types of clientele. So outside of market direction, money is going to go into ETFs. I think from a markets perspective, the rally continues to be hinged on a few tech conglomerates at this point. I think when we look at on the horizon, we are actually seeing a broadening of this rally from a growth perspective. The other 490 stocks in the S&P 500 in Q3 and Q4 are expected to have higher earnings per share growth. I think that is conducive to the broader market because we're starting to get more democratized growth, right? More than just a handful of stocks are leading the charge. I think that'll be helpful and be helpful from a market return perspective. I think that you'll see a significant amount of volatility in Q4 because of the election. I think that goes without. I'm not making a normative statement either way. I'm just saying that it is a macro event, and there happens to be a Federal Reserve meeting the day after the election. I feel like that's a thing that's going to create volatility, to use a
Oh
technical.
yeah.
There's just a lot of ambiguity. So I think watch out for some volatility in the fourth quarter. I think that would spur some interest in more tactical positions, whether it be gold or long-term treasuries from that perspective. And I think on the year, where we'll end up is from an ETF flows, we'll end up over the $900 billion mark. I have a very good feeling of that. I will say though, August will be a test on the trend. August, out of any other month, is one of the lowest flow months for ETFs, and I think it's largely just due to the summer.
Mhm.
So I'm really interested to see what happens in August if that trend holds, because you obviously have Jackson Hole, you have more presidential debates, you will have the what is it, the convention, a lot
Mhm.
of news out there. You'll start to see some earnings reports. There'll be more of a macro vortex. But I think all else equal, I think over 900 billion of ETF flows is within target. And then after that, ETF assets will be knocking on the door of 10 trillion. So in the US.
Wow, good stuff. So look for record or near record ETF flows this year. Volatility in the second half, or especially in the fourth quarter. And I guess August is going to be a time to go to the beach. But thanks a lot, Matt. We'll wrap it up there. I really appreciate you coming on and helping us out and breaking things down for us. And we will get you on here again, maybe at the end of the year, to see how close you came to your
Yeah,
projections. All
looking
right.
forward to it.
All right. Thank you, sir. Thanks for listening, folks. And I want to thank Matt Bartolini of State Street Global Advisors for helping us out. And we want to invite you to visit ETF.com to check out everything we've got going on there for financial advisors. Just click on the Advisor Center tab to start exploring. And also, let us know if there's something you want to see us write about or talk about. My email is jeff.benjamin@etf.com, or you can always find me on X. My handle is @BenjiWriter. Schwab Asset Management is proud to sponsor the Advisor Upside podcast with ETF.com. With bond market conditions looking upbeat for 2024, Schwab stands ready with a suite of low-cost fixed income ETFs. Learn more at schwabassetmanagement.com/welcome-ETFs.